Wealthy and Wise is your guide to value investing, powered by Team Invest.
Hi there, welcome to Wealthy and Wise. Well, predicting the future is difficult. In markets, it's often close to impossible. So how do investors make decisions when so much depends on forecasts? Well, in this episode of Wealthy and Wise, we look at one of the most powerful and perhaps often overlooked ideas in investing, stability, and why the most predictable businesses can be the most valuable. We'll compare and contrast a few companies using Team Invest's Conscious Investor program, and we'll answer a question from a viewer. You may email us as well at wealthy@ausbiz.com.au. Let's add some value. Well, valuation relies on forecasts, earnings, risk, and growth. But what if the real edge isn't predicting better, it's choosing what's easier to predict? In this segment, we'll unpack why stability matters, how it improves forecasting, and why predictable businesses can give investors a real edge. Joining me for that, Andrew Coleman from Team Invest. Hello, Andrew. Nice to see you again.
To see you.
Thanks for joining us. Okay, so when we are talking stability, how good would you say we generally are at predicting the future?
Pretty awful as humans, I think. I mean, the future is very difficult to predict no matter what it is you're trying to predict. But when you're trying to predict something as complex as business growth or macroeconomic indicators, you're now in the realms of guessing rather than reality. And of course, Dremin and Berry did a really famous study in the 1980s where they looked at US analyst forecasts 1 quarter ahead, just simply of earnings, and asked the question, how accurate were analysts, financial analysts, at predicting earnings in the United States market? And they found that market analysts were materially wrong. That means more than 10% wrong, 80% of the time.
Why is that? Why do analysts get it so wrong if they're looking at numbers?
Yeah, well, as Dremin and Berry showed, it had nothing to do with them being stupid, clearly. I mean, financial analysts are often very intelligent people. One hopes most of us are. But what we were simply doing is asking them to forecast the unforecastable. And if you looked at that same study of companies and divided them simply into 2 categories, as our founder John Price did, those companies who had a high degree of stability of earnings, in other words, companies whose earnings seemed to follow a relatively stable chart of a line of best fit, and those who didn't, it turns out that analysts were right most of the time when they're asked to forecast something that can be forecasted, and unsurprisingly wrong almost always when the chart they were asked to forecast was jumping up and down like mountain peaks.
Yes, so just to be clear, when we're talking stability, we're talking about stability in earnings. Not that they remain flat, it's just what?
Yeah, well, I think from our point of view here, where we're talking about stocks on Wealthy and Wise, we mean stability of earnings, because that's really what we can predict. We can't predict sentiment. What we can predict is the underlying earnings. But, you know, if you're looking at interest rates, you can talk about stability of interest rates. If you're talking about property, you can talk about stability of yield. What matters really is that the item that you're trying to forecast needs to be something that you have a high degree of certainty is following a path that can be known. Now, sentiment, by its very definition, jumps all over the shop, so you can't know that. And, you know, if you're trying to forecast the weather, as we know, it jumps all over the shop, it's very hard to forecast it. So both of those examples would be systems with very low stability. Whereas an example of a company that's very steady, whether that's flat or whether it's growing or whether it's shrinking, if it's doing that in a simple, steady path, that has high degree of stability. Think of it as likelihood that the next series or next item in the series follows the line of best fit of everything that's come before it.
So how do unstable earnings flow through to valuations in your view?
Well, they mean the valuation's unstable, right? I mean, we talked about it a couple of episodes ago when we talked about that, you know, earnings graph versus price graph. In a perfectly efficient market, the market should be matching price and earnings in relation to that formula. Price is earnings per share multiplied by PE ratio, and that sentiment element, the PE ratio, mean reverts. So theoretically, if a company's earnings are stable, its valuation should be stable. I'm using theoretically to do a lot of heavy lifting here, of course. And if a company's earnings are unstable, then so too will its share price be. Now, for a speculator or a trader, therefore, lack of stability can be a great thing. It creates opportunity for you to move in and out of the market. But for a long-term investor whose number one goal is to be virtually certain you won't lose money, and whose number 2 goal is to make sure that that return is an appropriate return for your risk, stability therefore becomes the critical element in making any future prediction.
Yeah, so to my earlier point, it's not predicting better. It's not getting that crystal ball really buffed up. It is actually just choosing businesses that are easier to predict. So, we like comparing and contrasting. And you're playing my game. You're playing along nicely today. So we've got the stability or the earnings charts of 6 companies, which will remain nameless. So, Producer Sue, let's bring up the first graphic to see what we're looking at here. And maybe you can just talk to us about why it indicates stability or why it does not indicate stability. Here we go.
Yeah, so if you look at it, and I think we're ordering these, by the way, if they're in the order that we talked about before, from least stable to most stable. Here's an earnings chart that would make it very difficult to predict, I think, if you were the analyst or the investor, what's going to happen in FY26 or FY27, next year and the year after. Because have a look at that. 10 years ago, earnings were 58 cents a share. It rose a little, then it fell, then it jumped high, stayed high, then it fell, then it jumped, then it fell, and then it went negative. So from that
even
point
I
of
can
view,
see this.
Exactly. So from that point of view, what number do you put in your model? What number is in your forecast? Should it be negative 96 cents a share, in which case clearly the business has very low value? Should it be $6.47 where it was at its peak, or anywhere in between? And the range there is so large that it would make the valuation pretty much unstable in any definition of that word.
Yeah, so let's get the other one, the next chart up, to see if we can see any stability emerging.
So this is slightly more stable, may not be in a good direction. If you have a look at that, you're seeing the beginnings of a trend coming through. Unfortunately, in this case, a trend that is of declining earnings rather than rising earnings. But have a look, started off at 1 cent a share, spiked to 8 cents, then fell to losses, and those losses have been slowly increasing in value over time. So still pretty unstable, but more stable than the first chart. So probably easier to predict next year and the year after. Here you say a slight increase in stability again, sort of almost like a normal distribution, isn't it? It sort of started low, went high, and it's come back down. I don't know if those at home would have a pretty good feel of where FY26 or 27 is going to fall, but it's probably above zero at least, whereas the last 2 charts, it could have been anywhere, and it could have been positive or negative. Now I think we can start to say it's almost certainly above zero, but where? Slightly higher stability again, trades in a relatively narrow band. We're now talking about stability somewhere between sort of 9 cents a share and 20 cents a share. If you sort of look at the line of best fit, just visually at that chart, you've got one loss here, but most of them are in that sort of range.
So you can even have a year of losses, and if you do your fundamental analysis, and you can perhaps find out why, and that doesn't blow the whole stability sort of thesis out the window, or does it?
I mean, look, it doesn't help. Each time that the earnings don't match a really obvious path, it makes it harder to forecast the next year to come, right? But at least in this chart, compared to some of the others, there's a sort of band of earnings that you could have a relatively high degree of certainty as an analyst that it will fall in. This one, of course, even higher stability. I mean, look at that. That's a pretty steady chart with the exception of 1 year being FY20, rising at a pretty steady rate year to year with one outlier. So again, that's higher stability than the ones we've seen before.
Yeah, and we all know what happened in FY20.
We did, so that may be excusable. But again, if you're just simply looking at this without the company's name and saying, how accurate is my forecast likely to be next year? You've got a much higher degree of confidence that you're going to get in the right ballpark with that company. And then this one, of course, almost looks like a perfect car, right? It does. I mean, it's a nice upward trend, which we want. But if you have a look at that, it's sort of an almost perfect line of best fit, a geometric progression. The change in interval each year is about the same percentage as the year before. Hence, it gives you that nice upward shaping curve. So as an analyst being asked to forecast this last company, you'd have a much greater confidence in what earnings you should put into your model for valuation than you would, for example, with company A, B, or C, where the answer could be anything from -$1 to +6.
Yeah, but I mean, that last chart was pretty easy to read, pretty easy to see the trend, pretty easy to identify how stable it is. I mean, is that like finding a needle in a haystack?
Yes, it's short answer. The question is, how many of them do you want in your portfolio, right? So when we run our analysis of the ASX, there's about 850 companies on the ASX, 1,850. And about 80 of them show a very high degree of stability, like that last chart, where earnings are either moving up, down, or sideways, but with what we would say sort of 90% plus stability. In other words, the predicted outcome is 90% of the time always within that bar. If you only want 20 companies in your portfolio, though, do you even need 80 to pick from? On the other hand, if you're trying to hold 200 in your portfolio, well, then stability may be something that you have to sacrifice. And I think that's the challenge, by the way. We're on the call a lot together. The problem often with being on the call is I feel like some of the time we're being asked to say buy, hold, or sell on something that is completely random. You look at the chart of the company's earnings, you read what they do, and you go, I have no clue if that's going to have a good year, bad year, or go sideways, because every year has moved up and down almost like a yo-yo.
Yeah.
And we're being asked to predict what's the share price going to be 12 months from now. It's a mug's game. On the other hand, some of those companies, I can say with quite a high degree of certainty what I think the share price will be.
All right, well, on that, I'm going to ask you to reveal what those companies are, and we're going to use that Conscious Investor software. All right, stay with us. We will take things head to head next. Well, understanding stability in theory is one thing. Seeing it in practice is another. So let's put it to the test by comparing those real companies and asking a simple question. How predictable are their earnings and what does it mean for valuation? So Andrew Coleman, Team Invest, is still here with me in studio to discuss. Okay, so we did set this up previously, but I still don't know what those 6 companies are. So I believe that we've got Conscious Investor software standing by. Let's take a look at that first company. Tell us what company it is and a bit of an explanation.
Yeah, so that first company who had the lowest level of stability of all of them we looked at was Min Resources. Now, that's no reflection on Chris Ellison or Min, that's just a simple reflection of commodity prices. As the price of iron ore in particular moves, so too do Min's earnings. As we bring it up on chart, what you can see here is that's exactly the same earnings chart we just saw, right? Starting low with earnings, spiking as the iron ore price reached a peak of, I think, $180 a tonne, falling down and then rising again with changes to the iron ore price, as you can see through that chart. So the challenge is when you're trying to look at a company like that and you're making a prediction, if you go to our calculate return page, which is our sort of way of quickly doing that in Conscious Investor, you can see that there are really a couple of ways of doing that. As we spoke about in our first episode of Wealthy and Wise, the first most common way in the market is to do a discounted cash flow analysis, and that's in a way what Conscious Investor is doing. Or you can do a multiples analysis, take the last year of earnings multiplied by the PE ratio and work out where you think it will be. In the case of what we've got here though, is we've got 3 columns, a default column, a safety column, and then an input column that we can change. And really what Conscious Investor is doing is it's saying, if the past continues the way it has been into the future, what is the sort of likely next path of what's going to happen? Now, in the case of this company, which I think we said was Min, what that's doing is it's saying take the average of the last 10 years PE ratio, 26.5, apply the average growth simply from the start of that cycle to the end 10 years later, so a simple percentage growth rate, and work out what you think the target price will be in 5 years' time, which is $64.53, which might look like a buy given the current share price is around $62.25. It's not a lot of margin in it, but maybe it's positive. On the other hand, take a margin of safety, so discount some of those assumptions. You can see what we're doing there is discounting the PE ratio and discounting the growth and the payout ratio given what's been happening at the company. And suddenly you end up with the company looking like a sell because the target price is down at $35.79. So the challenge for an investor, of course, and you can put your own inputs in on the right-hand side, the challenge for an investor looking at that is to say, which of those is going to happen?
Yeah.
Because if it grows at an average 4.5%, or maybe 10%, above 4.5%, maybe Min's a good buy right now. On the other hand, if it grows at only 2.5%, I should be getting out before the share price halves.
Yeah.
The reason that the gap is so wide comes down to stability. The more stable the company, the more confidence you can have in your prediction, that my percentage growth rate will be right, my earnings per share, my PE ratio will be right, and therefore the higher confidence you can have in an output. And I would say if you look at Min, and we look back at that chart, there is no way you can predict what the growth rate is going to be. That is jumping around so much that it could be anywhere from a negative number to positive 100.
Okay, so let's take a look. What was the next company? Company number 2.
Company number 2 was NextDC.
Oh,
we talked about it a couple of episodes ago.
Yeah.
Now, if you have a look at NextDC's earnings, exactly what we saw on that chart before, the light blue line being sales, the dark blue line being earnings, a steady downward trend in earnings, but with huge volatility between each period. So of course you have the problem if you want to calculate a value for next DC, well, you have to ask, what earnings am I putting in as my starting point?
Yep.
How fast am I growing those earnings? And how much confidence do I have that those earnings are going to come through into the future? And if you have a look, if we just go to the data page there, Sanji, thank you. Next DC, we can't actually calculate a growth rate over 10 years because you're starting at a positive number and ending at a negative number. The maths doesn't work. So what growth rate do you put in your model as an investor who wants to own next DC? And if we go to the calculate return page, you can see sort of the silliness that throws up. If we just play around with this on the right-hand side, if we copy across either of those and just say, let's assume that the company's PE ratio in 5 years' time is 20, the market average, and it grows at 10% per annum, so put that in. Well, because we're starting from a negative number, it's worth a negative amount.
Oh, okay. Yeah,
So
I can see
okay,
that.
so we adjust that. We say, all right, well, actually, 8.9 cents a share loss wasn't fair. Maybe it should have been 10 cents profit, so we make that 0.1 instead. And we still keep the same growth rate and all the rest of it. Well, now it's worth $2 a share, so it's still worth a lot less than the market. And you see what ends up happening. You end up playing this game where you try and fit the number to get the output you want. So if you're positive about next DC, you end up playing with those numbers until such time as $14 looks cheap.
Right. Okay, so let's get to number 3 to see what's emerging here. What company was that?
This was another one we spoke about 2 weeks ago. It was BlueScope, BLS.
Okay.
BlueScope still, so BSL. And if you have a look at BlueScope, when we go back to that chart, Sanji, that's the earnings that we just saw, spiking and then falling. If we have a look at its stability on the data page as a percentage, just so that people understand what that means, when I talk about it on the call, that's an earnings growth rate of 7% with only 35% stability. And of course, in the return page, that comes through. What number are you going to use to predict the earnings growth?
Okay, let's skip ahead. Let's skip ahead if we can.
Sure.
To that perfectly stable business at the end. What was that?
Yeah, that's technology one.
Oh, TNE.
Yeah. Which is not to say that TNE is potentially a wonderful purchase right now at its current share price. But what you can say with TNE, when you look at that chart, is it's highly predictable what's going to happen next year. Technology one has grown at between 13 and 16% per annum every year for the last 15 years. So if you're building a model or valuing that company, you're going to have a pretty high degree of certainty. In fact, our stability of 98% when you do the maths to calculate it. You can have a pretty high degree of stability that it's going to be somewhere between 13 and 16% in your model. So when you go to the calculate return page, what you should see, and what we do see as investors at Team Invest, is of course a very narrow band in sort of the assumptions we can use. So 14% growth looks like a buy, $33 target price versus $30. If you want to make that 15% over on the right-hand side, Sanji, so if you'll cover across default and change it to 15, sort of the upper end of what it's been trading at, still looks like a buy at 35. And if you drop it to say 13, the very bottom end of what it's been trading at, historical performance, it still looks like a buy at $32. So from that point of view, you can now start to say, because the stability was high, I can be virtually certain about my investing decision, whether that's a buy, a sell, or a hold. Whereas those first few companies, your guess was as good as mine.
Well, thanks for letting us see under the hood of the Conscious Investor program. Look, we're going to leave that. I dare say we'll be talking about stability in future episodes, but I did want to leave a bit of time to get to our viewer question because you asked. Okay, we'll get right to our viewer question for JS, who says, would you please apply your analysis to TIP? The share price has not performed, and I know it's not the only way to judge a company. Clearly, he's been watching Wealthy and Wise. However, I'd be keen to hear the team's investment thoughts about TIP shares, please, because, Andrew, for those of you who don't know, for those of you out there who don't know, TIP is a listed company. Team Invest Private?
Yeah, so we are... Team Invest Private Group Limited is the listed company.
Yep.
I'm the CEO of that. I'm the group CEO. We operate 3 divisions inside TIP, of course. The one which everyone on the call and Ausbiz viewers here at Wealthy and Wise is very familiar with, which is our education and advice business. So that's where we do, what we do here. We teach people how to be better investors. And we've got about 700 members around the country. We've talked about this lots, as well as corporate clients, with about 1.6 billion of funds under advice and a 20-odd-year track record, 25-year track record of delivering about 16.5% per annum for those clients in the portfolios they manage. That's the part that's sort of very obvious and we talk about here. The other two parts of our business we don't talk about a lot, and this is not my attempt to sell them, but just so that everyone's aware of who the company is, which is that we operate a funds management business where we really do the same thing on behalf of others, where we've got a 10-year plus track record of beating the market by about 250 basis points per annum after fees, which we're pretty happy with. And then we also, the majority of our business is actually deploying our own capital. We buy shares both in listed companies and in private companies. And we've got about 130 million deployed of our own money there, with an average return of 3.1 times money on invested capital, which is just a fancy way of saying for every dollar we've put in, we've got to date $3.10 back in return. So we sort of tripled our money on average on every investment, which we're pretty happy about. The challenge that sometimes happens when I get those questions is, which hat do you want me to answer it from? Because of course I'm the group CEO of TIP, and part of my role, though never on AusBiz, is to spruik the company. And as you can see, I've been an increasing buyer of our shares because we meet what a team invest criteria would be.
Okay, maybe we can pull up earnings.
Yeah, so we're a company whose earnings have been growing over the last sort of 6-7 years since we've listed. As you can see, they're at about 45% per annum. That won't continue. That maths gets harder and harder to do each year. So please don't think that that's going to continue. But it is growing steadily. And at the same time, amusingly, the share price has fallen, which from our philosophy as a Buffett or Team Invest investor is exactly the kind of scenario you want as a long-term investor. You know, earnings rising steadily while the share price is falling makes for a great opportunity for you to buy and benefit. And we're trading now at about a 60% discount to our book value. So one would think that that may indicate a good investment. But the challenge we have a little bit, I think, is just simply that I'm not very good at spruiking the company. I spend most of my time...
You're not one of those guys going out
You've had me on the call lots and on these shows. I spend our time talking about what matters to me, which is how do investors become better investors and how do we deploy our capital as investors better? Because at the end of the day, you know, share prices and sentiment are fleeting. They move up and down. We've spoken about that lots. But the earnings are real. And the cash flow that delivers lets you make more and more investments, whether that's in your own personal capacity or in my capacity as the CEO of a listed group. So I think when you're looking at the performance of any business, let's take TIP out of it, you want to look at the ability of the company to deliver meaningful growing earnings and cash flow, because in the long run, that's what matters. Share prices will go up and down. Our share price has gone down. I expect at some point it will go up, and anyone who's bought it now will be very happy. It's why I'm buying shares in my personal capacity. That's public, you can check that up. But you know, what matters to the long-term Buffett-style value investor is the business growing earnings stably? Does it have strong moats and understandable risks? And of course, do you trust the management? Because at the end of the day, that's what's going to drive your return, not changes in sentiment.
Look, I think it's a fair question from JS, and I'm glad you're game to tackle it because he does say that he's learned a lot from this program as well. So listen, you keep your questions coming in and we'll keep putting it to our experts on the program. And look, JS's question got me thinking. Little public service announcement, because we do get a lot of stock specific questions to wealthy@ausbiz.com.au for this program in particular. So we thought that we'd do a Wealthy and Wise stock special. So kind of like the call, which of course we reference a lot because a lot of you would watch the call on AusBiz. So I'm inviting you in the next few days, send in your stock requests for the team and we'll answer them next week with a special buy, hold, or sell. And we will use that Conscious Investor platform as well to dig a little bit deeper. And yes, Tip Group has not come up on the call, I don't think for quite some time, if ever. And so we've covered that one today. Let's get some fresh stock requests in and feel free to, add some context, whether you already hold them or whether you're considering buying those stocks, and we'll do our best to answer them for you with as much detail as possible. So stock specific special coming up next week. Andrew Coleman, as always, thank you. Thanks for joining us. And thank you for watching. We look forward to seeing you next week.
Wealthy and Wise is your guide to value investing, powered by Team Invest.